this is Josh Taylor with Trade Advisor Pro, and I want to thank you for checking out our video today. Now, before we get started with today's free Forex training video, I want to give you a chance to pause this video right now and go to our website. Trade Advisor Pro offers you free Forex training videos, and trade alerts. And folks, you do not want to miss our trade alerts. We send out a bunch of trade alerts every month that are top rated in the industry, where we send you our exact trades right to your inbox. Pause the video now, go to tradeadvisorpro.com/free, and all you have to do is register and then come back to this video, and we'll be sending you a lot more goodies to help you with your Forex trading. Enjoy today's training video. Alright, so we're going to use an example here. Let's say you have a $10,000 account, and you already made a decision and committed in your trading plan that you're going to risk no more than 2%. Alright? Now 2% of $10,000 is $200. So you are willing to lose no more than $200 per trade. Are you with me? That is the number one key, is you already preset in your equity management plan your maximum that you are willing to risk per trade, and you stick to the plan and don't change it. So in this example, 2% risk, you are willing to risk $200 on a trade. All right? Now the next step you need to do is look at your trade, and we'll talk about later on optimal entry and exit points, and you're gonna know in advance. In fact, you're gonna be setting these trades in advance. So every time you take a trade, you're gonna know three things. You're gonna know, number one, exactly where you're gonna get in. Number two, exactly where you're gonna place your stop. Number three, exactly how you're gonna be pulling your profits out. You already know in advance how you're gonna manage each trade. So the first thing you need to do is calculate the number of pips from your open price, which is the price you're going to get in at, and your stop. So let's show you a couple examples. Alright, in this example, we are buying the euro. In fact, if you see this right here on the screen, our Pro Signals direct customers, this is exactly what a signal that we would send out to them would look like. It'll say buy limit. That means you're buying a pending order on the euro US dollar at 13500. Our stop loss is 13400, and our take profit is 13700. Okay, now using this example, what is the distance between the open price, which is 3500, and your stop loss? It's 100 pips. Okay, how do you calculate that? You subtract 13400 from 13500. You get 100 pips. Okay, you have already committed in the last slide that you were going to risk $200 per trade. Okay? So you're going to take that $200 and divide it between those 100 pips. So you are willing to risk $2 per pip. So $2 per pip, if the trade went against you 100 pips, it would hit your stop loss, it would close your trade out at a $200 loss. You lost 2%. Alright? So now here's one thing that you need to understand, is one micro lot is approximately 10 cents. Now some pairs, especially the yen cross pairs, they're a little bit different. Some pairs are actually a little bit more, sometimes they're a little bit less. But on average, they're about 10 cents per pip. One micro lot. Okay? Now, we already said we are going to risk $2 per pip. Okay? So you can divide $2 into 10 cents and you get 20. An easier way to calculate it is take the $2 and put a zero at the end of it. Okay, it ends up being the same number. But when I start showing you how to quickly calculate lots, it's a lot easier just to add the zero. So you are willing to trade 20 micro lots on that trade. At 20 micro lots, if the trade went against you, how much did you lose? You got it, $200. 2% risk, and you are not freaking out. Alright, so let's look at another trade example. Almost the same trade, a little bit different. This one says we're going to buy the euro at 13500, but our stop loss is 134.50. So we're using only a 50 pip stop. The difference between 13500 and 134.50 is 50 pips. So we are going to take our same $200 maximum risk, and now we're going to spread that between 50 pips. Okay? Which equals $4 per pip is what we're willing to risk. Again, one micro lot is 10 cents. You take the $4 per pip, divided into 10 cents, and what you get is 40. So in that trade, you're going to be able to trade 40 microlots. Okay, this is very important that you understand how to calculate this. If you don't do that, rewind the video a couple minutes, go back to example 1, example 2, watch them a few times so that you understand. In fact, try some examples on paper and see if you can come up with your lot sizes. Okay, folks, I hope you enjoyed today's training video. If you have not done so already, stop this video now and go to tradeadvisorpro.com/free and register absolutely free for free Forex training videos, and free Forex traded alerts directly to your inbox. Go to the website right now and register for free. All kinds of goodies for you. Thanks a lot.